What if I told you that while the S&P 500 delivered a respectable 15 to 20% return in 2025, three specific ETFs absolutely crushed the market, delivering returns between 55 and 112% year-to-date? We're talking about gains that are 2.5 to 5.5 times better than the broader market. Today, we're diving deep into the three best-performing ETFs for November 2025, backed by verified data from official sources. These aren't random picks or speculative plays. These are real funds with billions in assets, delivering extraordinary returns driven by powerful macroeconomic forces. Whether you're interested in precious metals, the nuclear energy revolution, or the blockchain transformation, this video breaks down exactly what's working right now in the ETF world. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. Let's start with the absolute champion of 2025, the VanEck Gold Miners ETF, ticker symbol GDX. This fund has delivered a jaw-dropping 112.17% year-to-date return as of October 31st. 2025. Let that sink in for a moment. If you invested $10,000 on January 1st, your position would now be worth $21,217. That's more than doubling your money in less than a year. But here's what makes GDX so powerful compared to simply buying gold itself. This is a leveraged play on gold prices through mining companies. When gold prices rise, mining companies don't just benefit proportionally, they benefit exponentially because their profit margins expand dramatically. Gold miners have fixed costs, so when gold prices surge, every additional dollar goes almost directly to their bottom line. GDX currently manages $21.63 billion in total assets and trades at $71.91 per share. The expense ratio is just 0.51%, which is remarkably reasonable given the extraordinary performance. The fund tracks the market vector Global Gold Miners Index and has been around since May 2006, giving it nearly 20 years of operational history. Now let's talk about what's actually inside this fund. The top holding is Agnico Eagle Mines at 8.09%, followed by Newmont Corp at 6.89% and Barrick Mining Corp at 5.3%. These are the world's premier gold mining operations. The geographic diversification is impressive, with 46.5% exposure to Canadian miners, 17.6% to U.S. operations, and nearly 11% to Australian companies. You're also getting exposure to South African, Brazilian, and Mexican mining operations. So what's driving this unprecedented rally in gold and gold miners? Three massive forces are converging simultaneously. First, gold prices surged past $4,350 per ounce in October 2025, an all-time record that few analysts predicted even a year ago. Major investment banks, including J.P. Morgan, Goldman Sachs, and Bank of America, are projecting average prices of $3,675 per ounce by the fourth quarter of 2025, with some forecasts suggesting $4,000 per ounce by the second quarter of 2026. Second, central banks around the world continue to be net buyers of gold, accumulating reserves at historic rates as countries diversify away from dollar-denominated assets. This de-dollarization trend isn't slowing down. Third, geopolitical tensions and currency debasement concerns are driving institutional and retail investors towards safe haven assets. When uncertainty rises, gold shines. But let's inject some reality here. Gold experienced a healthy correction in late October 2025, declining approximately 9.5% from mid-October highs as investors took profits. This is normal within bull markets. Individual mining stocks have been even more volatile. Kinross Gold, one of GDX's holdings, delivered 128% returns in 2025, significantly outpacing even the ETF itself. The dividend situation is modest. GDX pays annually in late December with a current yield of just 0.37%. The most recent dividend was 40 cents per share. The risks are real and substantial. Gold price volatility can be extreme. Mining operations face cost inflation, regulatory challenges, geopolitical exposure in developing countries, and currency fluctuations. Most importantly, the leverage effect works both ways. When gold falls, miners amplify those losses just as dramatically as they amplify gains. Now let's shift gears to our second-place performer, the VanEck Uranium and Nuclear ETF, ticker NLR. This fund delivered 66.48% year-to-date returns based on net asset value as of October 31, 2025. Now here's an important technical note. VanEck reports two different return figures for NLR. The share price return shows 90.64%, but that reflects premium trading dynamics. For accurate performance assessment, we use the NAV return of 66.48%, which represents the actual underlying portfolio performance. This fund manages $4.09 billion in assets and trades at $154.92 per share with an expense ratio of 0.56%. What makes NLR so compelling right now is that we're witnessing a genuine nuclear renaissance. The most extraordinary development of 2025 has been major technology corporations embracing nuclear energy at scale. Microsoft, Google, Amazon, and Meta have all announced significant nuclear energy commitments to power their data centers and artificial intelligence infrastructure. This represents the largest corporate adoption of nuclear energy in decades. These companies need reliable, carbon-free baseload power, and nuclear is the only technology that can deliver it at the scale they require. But here's where the investment thesis gets really interesting. There's a massive structural supply deficit in the uranium market. Current global uranium production is approximately 1 million pounds annually, while total consumption is approximately 50 million pounds. That's a 49 million pound annual shortfall that must be filled from existing inventory drawdowns and recycled uranium. Those inventories are depleting rapidly. Even more critical, new uranium mining projects require 10 to 20 years from discovery to full production. You can't just flip a switch and create new uranium supply. This creates a powerful supply constraint that's only getting tighter. Let's look inside the portfolio. Cameco Corp leads at 8.16%, representing one of the world's largest uranium producers. Constellation Energy at 7.4% is a major utility operator. Oklo Inc. at 7.21% and NuScale Power at 4.29% represent the cutting-edge small modular reactor technology that's revolutionizing nuclear power. The sector composition breaks down to 48.29% energy companies, 33.35% utilities, and 18.27% industrials. Geographically, 51% is US-based with strong Canadian exposure at 16.61%. The policy environment is transforming rapidly. The Trump administration signed executive orders in May 2025 to expedite nuclear reactor approvals and boost domestic uranium production. Internationally, Japan is restarting 13 reactors. China is planning aggressive nuclear expansion, and Western nations are prioritizing nuclear for both energy security and climate objectives. Uranium prices currently sit around $75 per pound after a mid-year correction, but analysts project a rebound to $90 to $100 per pound by year-end 2025. Bank of America is forecasting potential prices reaching $135 per pound by 2026. The World Nuclear Association projects uranium demand will increase 28% by 2030 and more than double by 2040, reaching 150,000 tons annually. The dividend is more substantial here at 0.82% annual yield, paid in December. The most recent distribution was 61 cents per share. NLR has demonstrated impressive long-term performance with a 14.53% annualized return over 10 years and a 41.27% annualized return over 3 years. But the risks cannot be ignored. Nuclear projects face regulatory and permitting delays. Development timelines are measured in decades, not years. There's geopolitical risk in major uranium-producing regions like Kazakhstan and parts of Africa. The portfolio is highly concentrated with the top 10 holdings representing 56% of total assets. Uranium prices themselves can be volatile based on market sentiment shifts. Our third performer is the Amplify Blockchain Technology ETF, ticker BLOK. delivering between 55.5 and 66.64% year-to-date returns depending on measurement methodology. On October 13, 2025, the fund officially changed its name from Amplify Transformational Data Sharing ETF to Amplify Blockchain Technology ETF, better reflecting its focus on blockchain-based companies and digital asset infrastructure. This is an actively managed fund investing in 58 companies across the blockchain ecosystem with $1.42 billion in assets under management. The expense ratio is higher at 0.71 to 0.73%, but that reflects the active management approach. Bitcoin traded above $113,000 in early fourth quarter 2025, and analysts are projecting potential gains to $158,000 to $180,000 by year-end based on seasonal patterns, the quadrennial halving cycle dynamics, and surging institutional demand. Global Bitcoin ETF assets reached approximately $179.5 billion as of mid-2025, with U.S.-listed Bitcoin ETFs accounting for over $120 billion. In early October 2025, weekly inflows surged to a record $5.95 billion in a single week. The approval of spot Bitcoin ETFs in 2024 fundamentally transformed the investment landscape, eliminating barriers to institutional adoption. Let's examine what's inside Block. The top holding is Cipher Mining at 5.86%, followed by Galaxy Digital at 5.11% and CleanSpark at 4.65%. These are Bitcoin mining operations that benefit directly from Bitcoin price appreciation. You also get exposure to cryptocurrency exchanges like Coinbase at 3.7% and Robinhood at 4.42%. The fund holds positions in traditional technology companies integrating blockchain like IBM at 2.98% and payment processors like PayPal at 2.27%. Interestingly, Block also holds direct positions in Bitcoin ETFs themselves, with approximately 2.1% each in IBIT, BITB, and BTCO. The corporate adoption story is remarkable. As of September 30th, 2025, 176 companies have formally adopted Bitcoin treasury strategies, collectively holding 1,033,866 Bitcoin valued at approximately $117 billion. Portfolio holdings, MicroStrategy, and Metaplanet are among the largest corporate Bitcoin holders. The regulatory environment is transforming positively. The U.S. Securities and Exchange Commission launched Project Crypto to modernize securities regulations supporting blockchain innovation. 16 spot altcoin ETFs covering Solana, XRP, Litecoin, Dogecoin, Cardano, and others were awaiting SEC approval throughout October 2025. The tokenized real-world assets market is exploding. The tokenized U.S. Treasury market nearly quadrupled over 12 months, growing from approximately $2 billion in August 2024 to more than $7 billion in August 2025. Stablecoin assets are forecast to reach $500 billion by 2026, with major financial institutions including Visa, MasterCard, and PayPal integrating regulated stablecoins into global payment networks. Block's management emphasizes the convergence of artificial intelligence and blockchain technologies, particularly through smart contracts enabling automated trustless transactions across financial services, real estate, supply chains, and other industries. The dividend yield is attractive at 3.79% based on trailing 12-month calculations, paid annually in December. The most recent distribution was $2.59 per share in December 2024. The fund delivered 12.67% gains in September 2025 alone, with third-quarter returns reaching 17.71%. But the risks are substantial. Cryptocurrency price volatility is extreme. Regulatory uncertainty persists despite recent positive developments. Technology obsolescence risk is real in this rapidly evolving space. The higher expense ratio of 0.71 to 0.73% eats into returns more than passive index funds. So let's compare these three investments directly. GDX leads with 112.17% year-to-date returns, representing 5.5 times the S&P 500's performance. NLR follows at 66.48%, delivering 3.3 times the broader market. Block comes in between 55.5 and 66.64%, representing 2.8 to 3.3 times the S&P 500. These are three completely different investment philosophies. GDX represents safe haven demand, tangible assets, and a geopolitical hedge against uncertainty and currency debasement. NLR captures a long-term structural shift in energy policy, the transition to clean baseload power, and a decade-long thesis around nuclear renaissance and uranium supply constraints. BLOK represents digital transformation, institutional adoption of cryptocurrency, the convergence of blockchain and artificial intelligence, and the tokenization of real-world assets. These are not set-and-forget investments. Each carries significant volatility and sector-specific risks. Past performance never guarantees future results. The principle of diversification matters tremendously here. These could be thoughtful portfolio allocations representing 5 to 15% of a diversified portfolio, but they should never represent your entire investment strategy. I cannot stress this enough. Do your own research, understand your personal risk tolerance, and consult with qualified financial advisors before making any investment decisions. All the data presented in this video has been verified from official ETF issuer websites as of November 1st and 2nd, 2025. Now I want to hear from you. Which of these three ETFs interests you most and why? Are you drawn to the tangible security of gold mining, the transformative potential of nuclear energy, or the digital revolution of blockchain technology? Drop your thoughts in the comments below. If you found this analysis valuable, please hit that subscribe button. I'll be creating monthly ETF performance updates to keep you informed about what's actually working in the market. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.